We'll start the today's market talk.
Action for the sake of activity mostly results in mediocre investing, and in mediocre investing happens in case we get into investing oblique trading without giving due thought process to the result oblique actions. So be careful, take your time. You don't have to trade for the or invest for the sake of doing that. Whenever you get good opportunity, that is the time to take a call. Market status, as I see it, consensus is for the US economy that it is not likely to have a mild recession, and it may have a soft landing to no landing at all scenario, and which is encouraging investors to take on more risk. So the US interest rate uh, action will continue to be guided by incoming economic data such as non-farm payrolls and CPI. Data dependence will keep market volatile till we get closure on Fed pause by November oblique December. At least by that time, we would be clear that there would be more rate hikes or not. RBI kept the repo rate unchanged at 6.5%, maintaining the GDP forecast, but upped their inflation projection. So it implies that interest rates are going to be higher for longer. Funding costs for banks are likely to stay elevated, and banks' NIMs will be under pressure. Repo rate at 6.5, GDP forecast at same 6.5, and inflation projection at 5.4. So banks will have to focus on operating cost oblique expenses to drive profitability in FY24, because as we have seen, because of impact of lower NIMs, their profits are going down. India is well placed to capitalize on political and economic shift away from China. Last few years, Indian economy has strengthened, and the result is that companies like Apple and Foxconn have been attracted to set up business in India. PMI data shows that Indian manufacturing is a star performer. The earning CAGR of Indian equity market is expected to be around 13 to 17%. That is a median of 15% for the next few years. It implies that the the indices should double in 5 to 6 years. But if you think that PE multiples are high, it is because they are pricing in strong growth. PI Industries, with one of the results which came out last week, showed solid business model and which is justifying their rich valuations. They reported double-digit growth in revenue and profitability. The PE is roughly 32 times FY25 expected earning. Q1 FY24 performance is led by custom synthesis manufacturing exports and pharma, CRAMS and CDMO business, because they have now started contributing to the top line. CRAMS is contract research and manufacturing services, and CDMO is contract development and manufacturing organization. Custom synthesis manufacturing is where they provide product development services to innovator companies followed by manufacturing commitment from them. Hence, their revenue growth is not volatile and it is steady. Cummins uh, domestic market growth was good in revenues, but exports showed slowdown because of lower demand in key markets. They had around 31% year on year growth in revenues led by domestic business, but exports declined 3%. The segments they have segments out of which power generation grew 76%, but industrial and export segment declined. So if you see the FY25 expected EPS of 50 to 53 at 30 to 35 times PE is a good level to enter. So 1500 to 1600 should be a good level to enter Cummins. Max Healthcare revenue grew 17%, EBITDA at 26.8%, financial position improved, and they were net cash positive of 957 crore in Q1 FY24. So they had a good operational and financial performance in Q1 FY24. Their maximum revenues came from oncology, that is roughly 25%, and their hospitals are performing well. Dwarka Hospital, which they are creating a greenfield hospital, is progressing well, and they have increased capacity in Shalimar Bagh Hospital also. Now we will see the Nifty chart. This is a monthly chart of Nifty. If you see, we had four green candles, one after the other, from April to July. April, May, June, and July. The August till now has been a red candle. The point to look at here is that the red candle opened at the same place as the previous high of the green candle. So unless now the price moves beyond these 19,800 levels, it may be tough for the markets to move on. So this is the point which has to be kept in mind. Next we will see Nifty 50 one-day chart. Now here, as we have discussed, we can see three clear levels. This is that 16,800 level from where the market moved up in a March. Then it had five clear swings which took it to 20,000. Now it is here the bottom of around 19,300 was made last week, and this is the first level of support. If so, we can keep a stop loss of approximately 19,250 for short-term trades. If this one breaks, then there is likely to be a waterfall uh, price erosion, because we had a few gap ups when we went up from this level where we consolidated for a long time. This is a level which corresponds to 18,600, 18,700 on the Nifty. So these are the two levels to be watched, 19,250 and 600 to 700 over medium term for Nifty. This is not happening next week or so. Bank Nifty is the weakest because it has already fallen to the levels from where we had seen uh, the immediate rise. So the downward slope is more pronounced, and the target zone is roughly 43,500 to 44,000 area. Financial Nifty expiry is on Monday now because of holiday on 15th of August. So big up move is possible on Monday because of short covering. Most of the if you see the performances of most of the Bank Nifty stocks, they are basically short. Nifty 500, which is the broader market where where people trade mostly, is still looking strong, and it's above the 200-day moving average, 20 EMA also, which is here. So if this trend line is maintained, then the broader markets are likely to keep performing well. And if this 20 EMA breaks, that would be the reason for some worry. Now let's see Nifty IT. Nifty IT, after the fall last year, has been stuck in a range. So the bottom is around 26,100, where it has taken support thrice already, and the top is roughly around 31,500. Now it remains in this range. So let's see if this range is broken or not. Nifty Pharma is the index which is clearly on up move, and this has broken out from long-term trend line, and it is likely to do well. If you don't understand the pharma stocks, best option is to buy a Nifty Pharma Index mutual fund. Now, talking about stocks, Trent. Trent is engaged in retailing of apparels, footwear, accessories, toys, games, food, grocery, and non-food products through various of its retail formats and concepts. It's a part of Tata Group, operates Westside value fashion chain Zudio 50/50. It has a JV with Tesco plc UK to operate the Star Sports, operates Zara and Massimo Dutti as joint ventures. It's the only branded retail player with close to 100% share of private brands with a pan-India presence. It is following an accelerated store expansion program and there is an increased contribution from online channel. It offers a strong set of brands catering to all categories of consumers and it has helped this company report a highest average revenue per square feet compared to other branded players. It has maintained its same sales store sales growth momentum over the years as well as its profitability is seen increasing on a year-on-year basis. Aggressive store expansion, better store fundamentals, higher contribution from private brands, omni-channel network, and innovative product offering in the premium and value fashion space would be key growth drivers for the company going ahead. We will see this. It had a revenue growth of approximately 54% year on year in this quarter, and with the PAT growing at around 20%. Now they had 9 consecutive quarters of higher than 50% revenue growth, which is ahead of expectations. Their competitors are Aditya Birla Fashion and Shoppers Stop. So let's see their quarterly results. So if you see, the quarterly results are quarter and quarter. If you see June 22, they had 1800 odd crores of sales, and this time they had 2600 of sales. So it's a growth of approximately 50% regularly. Their margins are stable and their profits are also growing along with EPS. They are projected to do 10,000 crore revenue in this financial year and around 13,500 or 600 crore revenue in FY25. So their EPS is expected to reach around 40 in next year financial year. So they would be on a P of around 40 to 45, which is reasonable. Hence, there is a upside still left in the stock. Coming to the chart, it was trading around its 20 EMA, and then after the results, it had a breakout, and it is now very hot. So we should expect this stock to correct a bit, let it come to its 10 20 EMA, so as to make an investment call. The other good stock which I have found is Mrs. Bectors Food Specialities. Mrs. Bectors Food Specialities Limited manufactures biscuits and bakery products that are marketed under Mrs. Bectors Cremica and Mrs. Bectors English Oven brands respectively. It is a contract manufacturer of biscuits like Oreo and Choco Bakes for Mondelez. The revenue mix is biscuit division 60%, contract manufacturing 5%, and breads division 35%. It is the sole preferred supplier to some of the leading international QSRs such as McDonald's, KFC, multiplex chains such as PVR, and cloud kitchens such as Rebel Food Private Limited for burger, buns, muffins, garlic bread, and other bakery products. Scale up of capacities in biscuits and bakery segment along with distribution expansion will help the company achieve approximately 2400 crore revenue at higher capacity utilization. So this is they are targeting at. Market share in North India increased by 60 basis points to 4.6% and Pan India the market share grew by 34 basis points to 1.43%. So they are like a shark in an ocean and they have a huge opportunity. If you see their quarterly results, the results are improving quarter and quarter. Revenue is growing. Operating margins are If you see quarter and quarter from 10%, it has year on year the operating margin from June 22 from 10% has reached 15% because of higher value added project products and operating leverage. So the revenue growth, if you see, as compared to year on year, is around 24%. Operating margins have improved, and profit after tax, that is, it has improved 2.7x times, which is exceptional. So if you consider the FY25 EPS, uh, this is not a very expensive stock. They are doing capex to expand capacities to 450 to 500 crore. The key drivers are that the rural demand is picking up and the inflation in prices of key raw material is stabilizing. You see, as I was mentioning, though they are projecting they will do 2400 crore revenue next year, but even if it is 1860 crore revenue, EPS is expected to be around 28 rupees. So at 28 rupees, it is around 30-35 times FY25 earning, which with their growth rate and operating leverages and margins is still decent. See their segment-wise performance. Biscuits, bakery all had year-on-year around 25% growth and quarter-on-quarter around 6 to 10% growth. As compared to their peers, they are still reasonably priced and they have a long runway of growth as compared to their peers. You see their chart. Again, they were at 20 EMA, and then after the results, there was a gap up, and then the price has just moved up to around 1000 level. The company's strategies hinges towards achieving consistent double-digit earning growth, focusing on multiple levers such as enhancing capacities to prepare for company for future growth opportunities, and transforming its selling and distribution infrastructure to extend its geographic presence and expand its distribution reach. So if they are able to do all these, then their targets of 2400 crore revenue is likely to be achieved. So this is a stock to be kept in mind. The next stock is APL Apollo Tubes. It's one of the leading branded steel product manufacturers. Makes 1500 varieties of black pipes, galvanized tubes, pre-galvanized tubes, structural ERW steel tubes, and hollow sections to serve industry applications like urban infrastructure, housing, irrigation, solar plants, greenhouses, and engineering. Q1 FY24 operating earnings came lower than expectations at around 307 crore, down around 5% Q on Q. The steel prices corrected by 10% during the quarter, keeping buyers at bay in anticipation of lower prices. Destocking led to trade discounts to push higher volumes as well as inventory loss. So company had an inventory of 70 kilotons to 80 kilotons, resulting in inventory loss of rupees 38 crore due to fall in steel prices. So if you add this 38 crore, they would have been as per their expected profits. The demand is quite strong now, despite monsoon season seasonality in construction space, and capex during the quarter stood at 180 crore, and they will do approximately another 250 to 280 crore for rest of the year. So as we have seen, their lower operating profits were due to trade discounts and inventory losses. They are expected to reach 5 metric ton per annum capacity in FY24, and share of higher margin products is expected to go to 70% in FY25. At ROE of around 32%, which is expected, they would have an FY25 expected EPS of around 55. So, which makes it their valuation at around 30 to 35 times P. And despite all the problems, they reported highest ever sales volume of 661 kilotons. We'll see all this. So, if you see their quarterly sales, though the revenues is growing up, but here if you see the operating profits came down. The margins are though steady around 6 to 7%, but the net profit dipped and the EPS dipped. So there was this hit of loss because of inventory of around 38 crores at this level. But year on year, the growth is good and the profit growth is also good. Now, they recorded, as I mentioned, the highest sales volumes, up 56% year on year to 662 kilotons. The sales are growing by roughly 32% year on year. And net sales in terms of value, highest higher volume is led by 58% year on year growth in EBITDA. That means operating margins are good, and EBITDA per ton though declined, but it is still steady to roughly 4,645 per ton. You see that chart, the stock had a rise from May June levels, and after that, after the results, it had a fall because of slightly weaker results. But then once the market understood after the management commentary about the reason for the fall, the stock recovered. But it took support at around 20 EMA. So this is the level to get into this stock. Now talking about certain option strategies which I took last week. This is called a bear put spread strategy. To implement a bear put spread, we implement this strategy when the market outlook is moderately bearish. A conservative trader would implement bear put spread strategy by simultaneously buying an in the money put option and selling an out of the money put option. If I'm full on bearish and I expect the market to go down or a stock to go down, then I will straight away buy puts. But if I'm moderately bearish, then I don't want to take the chance because the market may still go up also. Hence, this strategy is taken. Both these options, that is selling an out of the money put option and buying an in the money put option, should be of the same expiry and same underlying. Selling the put option with the lower strike price helps offset the cost of purchasing the put option with the higher strike price. It is because when you buy a put option, you pay premium, and when you sell the put option, you get the premium. Therefore, the net outlay of capital is lower than buying a single put option outright. Now, let's see the Nifty option chain for next week expiry. The spot is at 19,428. So, in the money put is 19,450, where the premium is 75.6, and out of the money put is 19,200, where the premium is 15.30. So just remember these two. We will use these two puts. So what is the spread we can take is if the Nifty spot is at 19,428. So the 19,450 PE is in the money and 19,200 PE is out of the money. So we sell the 19,200 PE. The premium received from the sale would partially offset to finance the purchase of 19,450 put. So premium paid for 19,450 put is rupees 75.60. We saw it from the option chain, and premium received from 19,200 put is rupees 15.30. So the net debit of this transaction would be 75.60 minus 15.30, that is 60.30 is the net debit. Now what will happen in the first scenario? In case the market expires at 19,600, that is above the long put option, that is 19,450. If you remember, we have bought a put option at 19,450. So if the market expires still higher than that, that means our basic premise has gone wrong, that the market is bearish. So in this condition, both the put options, that is 19,450 and 19,200, would not have any intrinsic value, hence they would expire worthless. So all the premium we have paid is gone, that is we will suffer the loss of 75.60 for the premium we have paid for 19,450 put which we bought. But because we had sold 19200 put, we will get that premium, that is 15.30. So our net loss is reduced to 60.30. In the second scenario, if the market expires at 19450, that is at the long put option level. At 19450, both 19450 and 19200 P would expire worthless. Hence, similar to first scenario, it will still result in a loss of 60 rupees 30 paisa. Now let's take a third scenario where market expires at 19390. I'll explain why I took this 19390 level. The In this case, the difference between 450 and 390 is that 60 rupees, which is the my cost of taking this option also. So that is just for reference. So at 19450p would have an intrinsic value equivalent to max of 19450 minus 390 oblique 0, so which is 60 rupees. So and we have paid a premium of 75.60 for 19450p. Hence, I would recover some of my premium, that is 60 rupees. So my net loss would be rupees 15.60, which means that the net loss on 19450p at this stage would be rupees 15.60 and not 75.60, which was in the first case. But in this case, I would my 19200p would also expire worthless. Hence, I will get to retain the entire premium of 15.30 and overall loss hence would be 30 paisa. So this is basically a no loss no profit situation. Hence 19390 would be the break even point of this strategy. Scenario 4 is market expires at 19200, that is at short put option. This was a put option which we had sold of 19200. So if it expires at this level, 19450p would have an intrinsic value equivalent to max of 19450 and 192 minus 19200 oblique 0, which is 250, paid a premium of 75.6. Hence, after compensating for premium paid, I would retain 174.4. And for 19200p, which would also expire worthless, entire premium of 15.30 would be retained. So net profit at this level would be 174.4 plus 15.3, that is 189.7. Now in the last scenario, market expires say at 19,000 below my short put option also. So that means the market is bearish in a big way. So 19450p would have an intrinsic value equivalent to max of 19450 minus 19,000 oblique 0, which is 450. We paid a premium of 75.6, so I would retain now 374.4. 19200p now would have an intrinsic value equivalent to max of 19200 minus 19,000 oblique 0, which is 200. And since we have received a premium of 15.30, so I have to bear a loss. So my loss would be 200 minus 15.30, that is 184.7. So a gain of 374.4 and a loss of 184.7. Hence net profit is 189.7. So what we have understood from this strategy is that strategy makes a loss if the spot moves above the break-even point. Break-even point, if you remember, was 93.90, which was the difference between the highest strike, that is 19,450, and the net debit, that was 60 rupees. 60 rupees. So the break even was 19,390. So above the break even point, we make a loss if the Nifty is above that, and below the break even point, we make a profit. But in this case, there are no unlimited profit and loss, they are capped. So this is for moderate traders. Spread is the difference between two strike prices. So in this case, the spread here was 450, 19,450 minus 19,200, that is 250. So net debit, as we have seen, is premium paid minus premium received, was 60.30, which we paid. Break even was higher strike minus net debit, that is 19,450 minus 60, that is 19,390. Maximum profit is spread minus net debit. Spread was 250, net debit was 60.30, 189.70, and maximum loss is equal to net debit, as we have seen in two cases, is 60.30. So as we can see from this strategy, both the profit and loss are capped, but the risk is reduced if you take this bear put spread strategy. I have finished. Any questions, please?